Your host, Josh Appleman, founder and CEO of Appleman Properties. Today, we're joined with Jefferson and John Ortiz. They both founded Ortiz Equity Group in 2019. They have amassed 166 units with 178 more under contract. Jefferson, and John, we're happy to have you here today. If you could let the listeners know a little bit more about yourself.
Yeah, thank you so much for having us. We definitely appreciate the opportunity to share a little bit about our journey. Yeah, so it all actually started with us. We're actually originally from Colombia, and then we immigrated to Canada just right about 2002. No, that was back early 2000s, I want to say. And then we grew up in Canada our whole life. Grew up. I myself, right after high school, ended up becoming an insurance broker. And then John went into the logistics industry, and I know he can touch a little bit on exactly what his role was. But yeah, we kind of just follow the normal path that most people do: go to school, get a job, work a 9 to 5, and eventually try to retire from that. And yeah, we didn't really find that was what we wanted to do. We wanted to do more. We wanted to, we had the entrepreneur bug. Like most people, we read Rich Dad Poor Dad. And it was actually sent to us by somebody who wasn't an investor. He was just this ordinary guy, John's friends actually, and that kind of led to a whole path of like financial freedom, trying to learn a little bit about that. And then in 2020 we started our wholesale company. That's how we got it started in real estate. So we started a wholesale company. In our first year we did close to about 40 deals, like between 37 to 40 wholesale deals. We also picked up some smaller multifamily properties, and again, this happened all in Canada. And then yeah, 2020 we picked up some small multifamily, did the whole burst strategy. And then what we found is that we didn't really want to invest in Canada for many reasons. Much like there's no inventory, like the 100+ units. There's no inventory in that sense. There's no The regulations are very much in the tenant friendly, so it's very hard to scale that way. And then we just we wanted to invest somewhere where we wanted to invest. Sorry, where we wanted to travel, and that's kind of what led us to look into North Carolina, South Carolina, and then we joined a community. We joined a mastermind, and then we got an opportunity to become part of a deal. 137 units in Charleston, South Carolina. We're actually in the midst of selling that asset currently as we speak, and it's been a pretty good learning experience, and good to be foot on the ground. And yeah, it's kind of where we are right now. Now we're focusing on helping Canadians invest passively in the U.S. as well as Americans. And then yeah, we, as you mentioned, we have another 170+ units in Georgia that we're getting close to close on. So that's in a nutshell, a little bit of we can kind of dive into a little bit. John, anything you want to add?
No, you touched on all the good points. Yeah. For the last couple of years, we've just been building that corporate structure to be able to help Canadians passively invest in the U.S. As you know, obviously there is a border in between. So, learning the whole corporate structures, doing transactions with lawyers that are able to do both sides, and just building a system, a CRM database, and making sure that we have everything in place to be able to go out there, hunt deals, and help Canadians hit double-digit returns, something we can't really get here in Canada.
Yeah, Canada's tough with real estate in general. What's going on there?
Yeah, I mean, it has to do with a lot of the laws and a lot of the regulation that goes on in Canada. So basically, just kind of backtrack a little bit. One of our first purchases was a duplex, and where we had a tenant that wasn't paying, and it took us almost a year before we got her out, and she essentially got away with a year of not paying rent, damaging the property, and she kind of walked away free and clean. So it's kind of the system, the way the system is built is not really meant for entrepreneurs or landlords, in my opinion, right? Of course, you can still do it, but it's a lot more challenging. It takes you a lot more longer to execute a business plan if it is a value add opportunity.
Yeah, even like home prices, from what I read and hear, home prices are so out of touch with what reality is, and it's just, and then inventory, there's nothing to really buy, and it's, if you can't buy it, it's too expensive to even afford it. Is that right?
Yes.
That is correct. As you know, majority of the Canadian population lives right across the border between Toronto and Montreal, and there's a huge housing crisis. So there isn't enough supply for the demand that there is, as well as the amount of immigration that the government lets in a year. Everybody wants to live in that same little bubble, close to Toronto, close to the
Ontario.
metropolis cities, and it's hard for people to afford homes, and there isn't just enough supply. So
And it's really hard to build, I would say. I would add to that. It's really hard to build. The government makes it really hard. It takes a long time. There's a lot of fees associated with that. So builders are not really incentivized to build here. So, it creates this backlog of housing that never comes on the market.
That's wild. That's what politics got the different regimes in office, and they can make it either thrive or make it tough.
And you can see it a little bit in the states as well, right? Some of the blue
Yeah,
states compared to the red states, how some are thriving, some are not thriving, the crime, all these things. I think it's kind of shows you the both sides of the spectrum.
yeah, 100%. So that's good. So you're looking at opportunities in the states, good markets. That way you all can create passive income for your investors. Explain to the listeners the concept of passively investing in multifamily.
Yes, absolutely. It's something that we were introduced to, and we really like the concept of allowing, essentially, obviously, depending on your type of raise that you're doing. There's 506B and 506C. 506 being friends and family, 506 being accredited investors. I guess that's the first thing to touch on. And then the other thing is that obviously, let's say you're a busy professional and you want to invest in real estate, but you don't have the time, you don't have the knowledge, you don't have the expertise. Well, you can partner up with a group like ourselves or a group like yourselves, and essentially invest passively in a large asset that otherwise wouldn't be allowed. You wouldn't be able to put together because there's the financing, the final deal, the underwriting, the asset management. So essentially, people can invest just like you would invest in any other investment class, except this one actually gives you a good return. Typically a cash on cash return, but then you don't have to do anything. You can enjoy the beautiful things of life. And we actually just created a web. We just did a webinar a few weeks ago, and where we showed people how you could get to close to $10,000 of passive income through passive investing over a 10 to 15-year period. And it really goes to show you how you can really build that wealth. A lot of people talk about building financial freedom, getting passive income, but from there to executing and actually getting it, there's a lot more moving pieces. Anything you want to add, John?
No, no, Jeff, you touched on all the good points, but yeah, mainly just helping, people that don't really understand um, the basics or the foundation of investing in large apartment buildings, especially in the U.S. We have nothing like it in Canada, so people will usually put their funds or their savings in an RSP or a TFSA account where they're just getting, 4.5 cash on cash the most,
Not
and
even. I would say even lower than that. Say
yeah,
like
probably
2%.
lower than that. And we're able to, be able to multiply their investment and give them a good cash on cash return year over year. And our huge criteria when we're investing is the value add. So when we're underwriting deals, we're also investing a huge portion of our money because we believe in this deal and our investors are behind us, making sure that, they're getting what we're investing into as well.
Yeah, for sure. Let me take a step backwards because I like to start on the onset. You all got into real estate. You started doing wholesaling. Let's talk about how you all started and built and then scaled that company because that's cool that you all started with wholesaling because it's fundamentals. It gives you all the transactional process. It gives the person transactional process, and then it's a way of also creating revenue in order to do and get into other deals too. So I'll let y'all, if you could touch for the listeners, touch on that piece.
Yeah, absolutely. I mean, so when it came to investing in real estate, I'll be honest with you, me and John growing up, we didn't know this was a path. We didn't know this was a route. We didn't know you could become an investor. We didn't know that was a route or a path that you could go. We, like most people, that 9 to 5, go to school, work for somebody. That was the normal path. So what we did is we essentially learned about real estate. Wholesaling sound very attractive because you can make money up front without really putting much capital and without actually closing on any deals, but you're still getting some of those profits. So essentially, we hired a coach in December. That was December 2020, and then I would say that's what allowed us to scale our wholesale business because then it gave us confidence when we're going out talking to a seller. And essentially for wholesaling, for the listeners that may not know, is you find a good opportunity or somebody who is motivated, you lock the property under contract, and then you find a buyer, you assign your rights to that contract to the buyer. And depending on how good the deal, I mean, we've done deals as big as 40 or $50,000 per deal, per transaction, right? So that's essentially, we're essentially helping the seller because they're in a distressed situation, but then we're also helping the buyer get good deals, get amazing returns. So that's kind of how we started. And then, like you mentioned, Josh, that's a really good point. You do get to build on the fundamentals of real estate, which is find a good deal, underwrite a good deal, negotiate a good deal, do diligence on a deal. So I really feel like that part of our business really transition into multifamily because now we're just dealing with a different product and of course a much bigger asset. But yeah, wholesaling. Me and John always encourage people to start there or at least get familiar with getting off market deals, underwriting the deals, just get familiar with the process. Because once you go through it once, you can do it multiple times. And yeah, now we got to a point where we got employees, we got folks that are doing the walkthroughs, they're doing all the other ounces of it, because we've done it so many times. We're able to build that from scratch. Yeah.
Are you all now buying and renovating and selling? Or are you still doing wholesaling?
Yeah, so we still got our wholesale active business. We're just not as involved with it as much as before, because we do have outsourced. We built some systems around it. Our main focus and bread and butter is the multifamily, especially in
Yeah.
the US. Now, keep in mind, we are still acquiring assets in Canada. However, we have really strategic partnerships in Canada that and where we're not really actively involved. We're finding the deals, we're passing on to our partner. He takes it to the finish line essentially. But in the States, we're full on operations. We're looking at deals, we're underwriting deals. We just see the vision in the States. We see the future. We see what can be done, and the way you're able to scale up, and it's a no-brainer. The States is kind of where we want
Yeah.
to be, planted our seed and
Yeah, and I like that. And I'm sure your investors they like the fact that you all are active with other businesses as well. Keeps your knife sharp, your axe sharp, as far as keeping your finger on the pulse of what's happening in the markets out there. Because single family has a lot to do with just the economy in general. It's a trickle down effect. If trading slows down or stops in single family, it affects a lot more than just the housing market. As far as service providers, material providers, just on and on and on. So having that
Absolutely.
as an arm of the company, it helps offset some other different things as well. Um,
Absolutely. I mean, we do a lot of marketing, and what we're finding right now with sellers specifically, or owners of houses and buildings, of course, is that they're over leveraged. They bought things that were not assets, they overpaid for it, and now they're in a really messy situation where they're on a variable rate. Their mortgage payments were 1,700, now they're up to 3,000 or more. So now they're in a situation where they don't know what to do, right? So, and I think we're going to continue to see that not only in Canada but in the States as well. So just people that are just over leveraged, they didn't buy assets, right? Like we tell people, an asset has to be producing income. If it's taking money out of your pocket, it's not an asset; it's a liability.
I
So yeah,
think the other hidden piece is you've got a house on a great interest rate, and then you've got some people went out and took a second mortgage on it with, say, a 6 or 7% interest rates, and you've got a blended 5.5. No matter what, your payments went up, and now you've got just other elements that are coming in. It makes it untangible to meet your obligations on a monthly basis. There's elements happening in the markets right now that we just don't know what the results are going to be. But very cool. I was reading on one of your case studies. I wanted to ask you this: how does a 100K investment turn into 1.5 million in 10 years? So I wanted you to get into this one.
yeah, absolutely. So I can touch on it. John can touch on it a little bit as well. We did a webinar on it where we simply just took a case study example, not particularly us, but what we've seen in terms of returns and whatnot. And essentially, what it is that first thing is you have to come up with 100,000. So whether you learn a high income skill, or whether you sell an asset, or whether you sell a profit, the main goal is to have 100,000 of money to play with in the first place. Now you take that 100,000 investment. Again, these are those projections; these are not set in stone. But you take that 100,000 investment, you invest it into a syndication that gives you between 7 to 10% cash on cash return, and then typically, because these are landlord friendly states, you are able to turn over the units as the leases come up for renewal. So essentially, you're able to again give a return to your investors. So let's say year over year, they're getting between 8 to 10% cash on cash. But then at the end of the third or fourth year, which is typically between 3 to 5 years, it allows you to execute on your business plan, renovate the units. By that time, by the third or fourth year, you're then able to take that 100,000, and essentially the plan is that it should turn into 200 to 250,000, 2x your money essentially, right? So if you do that over a period, right, and you do it over and over again, and you just keep reinvesting your proceeds instead of going out and buying liabilities, that investment of 100,000 will turn to 200,000. 200,000 will turn into 400,000 in a couple of years. That 400,000 will turn into 800,000, and by the time you're in your 12th, 13th year, that 800,000 would have turned into 1.4 million essentially, I believe, give or take. And then if you invest 1.4 million dollars into a syndication that is providing you between 8 to 10, even 7, even call it 7 to 10% cash on cash, That's the formula. So that's kind of what we've seen, and that we've seen other operators and other people that just keep investing their proceeds, and essentially that 100,000 will turn into 1.4 million. But more important than that is that 1.4 million of the cash on that, the returns are between 10 to 15,000, depending again between 7 to 10% cash on cash, and that is literally a roadmap of how you can create that 10 to 15,000. Now, what we found is some people were like, well, that's too long, right? Like 10, 15, even call it 20 years, that's too long. But then, yeah, they go work a 9 to 5 in exchange 40, 50 years of their life. But, 10 to 15 years seems to be
15
long.
years will come sooner or later. That's part of it. But yeah, if you can take out your, call it 2.5, 3 years, take out your initial equity. I mean, you're riding on an infinite thereon. So the return is you don't have your initial capital, and just pull it out, put it wherever you would normally put it, and then your ride is infinite return from there on. It's very cool. Very cool.
No, exactly. Yeah. So obviously it depends, and you touch on it as well, right? It depends on what the business plan is. I would say obviously our plan is mainly to sell, but obviously there's a chance to refinance and recoup that money. That's another opportunity. But like you mentioned, Josh, if you refinance it, you give your investor their capital back. Like you said, now we're talking about infinite returns, right? Or if we sold the asset, then you should essentially 2x your money. So it's a win-win we go through. But that was kind of just the roadmap that we created. But yeah, you touch on it right away. You refinance it, pull out all
Yeah,
the capital. You're
I think there's a lot of young professionals that when they first get their 100,000 and they want to go out there and invest, they don't most often make the right decision. So we try to educate them as much as we can. Like, hey, on this asset class, we're able to control the value by the net operating income. And so we kind of educate them on this is what we do. But most of them, they might go out there, they might buy a car, they might try to do their first flip and get into the trenches, and then they're like, oh, screw it, and back out, and then kind of lose their investment. So we try to educate people as much as we can about the fundamentals of real estate, and then large syndications, which is what we focus on.
Yeah, I think a lot of people they don't see the alternative asset investing out there. You think of investing, you think of the stock market, you think of your 401k or
Yeah, even the stock
mutual
market right
funds.
now can take a huge turn with all the political stuff that's going on between the U.S. and China,
Yeah,
right? Like it can take a huge flip anytime, and you have no control over it,
no
unfortunately.
control over it. Yeah.
yeah, yeah. At least you still can go out and feel, touch, and see the bricks or siding on the houses. So, how do you all manage the investment process, the cycle? Once you have somebody comes to you and they find interest, how do you manage the entire cycle of it?
Yeah, absolutely. So our main focus, because we are based out of Canada, our main focus is on investors relations and asset management. However, we do have a pretty good and experienced team that we work with in terms of on the ground, boots on the ground, managing the asset, executing the business plan. So we just kind of align with a really good team with a track record, and then essentially we're focused on the raising equity and then asset management. So yeah, we have just strategic partnerships, and where we bring the investors, we buy the asset alongside with our partners, and then we just start executing a business plan. We have our own in-house property management team with our team, and then we already have bought assets in near where this area is, where these assets are. So it just kind of rinse and repeat because we already have executed on that pro forma on the rent. So that's kind of essentially how I would say we operated. So just very strategic partnerships and working with folks that have been doing this a lot longer than we have, so that way we can make sure we're bringing the best of the best when it comes to performing, executing the business plan, underwriting, and so on. Anything you want to, John?
No, Jeff, that is correct. As most syndicators know, the most important thing about syndication is team. And we have a team that we've been working with for the last couple of years, and we're like butter and like peanut butter and jelly. We work off each other very well, and we're able to use um, their team, and they're able to use our team, and we just connect really well, and able to bring on investors. And they have a really good asset management team, and that Sunbelt region where they do North Carolina, Savannah, and we travel down there every couple weeks, and we sit down with the asset management team, see how they're performing, see how the asset is performing, and yeah, no, it all works really well.
And then and then we have every quarter we have updates, regular updates of the asset. We do every week we hop on a call with the whole asset management team. We go over performance, vacancies, so and so on. So that's essentially how, because you're buying a bigger asset, you are able to leverage, the leasing office, then you have the property management, and then we have the asset management. So essentially there's three categories of people that are looking at the asset and managing the asset, as opposed to a single family, a duplex. It's going to be yourself in the property management, and the property manager is not gonna he's not gonna focus on that asset as much because it's so small, right? They're not getting paid as much, so then they're not gonna manage it as well as they would a bigger asset.
Yeah, and then that's kind of like why we transitioned into fully owner operator. We had third party property management in front of us. We would buy the asset, renovate it. While we're renovating, we'd have to lean on the property manager, and there's just a break in communication, a break on being able to really push hard, push down on the pedal, and get full performance out of the property. Now we're able to leverage and squeeze expenses as hard as we want to. We see all the invoices coming through. We're able to negate invoices if we feel like they're too high. We have total control, and I think that's why we've seen a huge spike in performance of the property. We were doing everything right up front, but
Mm.
when it came to the operations, we couldn't get in alignment of interest. And even if we don't make anything on asset management, that's fine. It will come sooner or later. Just push as hard as you can. Make sure the asset's going to perform now, and just do good. Make the property just perform. But
Absolutely.
scattered sites is a lot harder than say a 150, 200 unit site as well. It's when you're operating a bunch of scattered 40 and 50 unit properties. So third party property management is a little tougher.
Absolutely, yeah. We had a gentleman on our podcast, and we were talking like last week actually, and we were talking about exactly about this in-house property management and how much he said is day and night the difference, right? This day and night the difference between in-house property management and third-party company. One thing that he mentioned, which I thought was a good point, and I wanted to bring up because I think it will bring some value to the listeners, is that if you have a third-party company, right, and they're managing your property, but then they're also managing 10 other properties nearby, why would they focus more on your property than all the other properties? If let's say there's a unit that comes up, right? Why would they focus more on yours than on all the other ones? Essentially, for them, you're just another number. Obviously it depends on the property management. I know some are good, some are bad, but essentially you're just another number. But if you have that in-house property management, you guys are all in alignment of what you're trying to accomplish. So it's much everybody just in the same page, so everything just aligns a lot better. That was just kind of something I thought was interesting.
Well, and when you have essentially two separate companies, like you alerted to, the property management companies in for profit. They have to make money in order to make their own payroll, to make their own bills. So they've by default they have to fee the property. It's
Mm.
just the way it is. If we're not relying on our end, we're not relying on property management to stand up our company. It's a part of the overall business plan. We want to make sure that our properties survive and thrive, not necessarily our property management company. That's just a
Mm.
part of the mix. So it's we've seen a huge difference. It was tough at first, but um, it's I think it gets to a point in time where you almost have to bring it in house and become fully vertically integrated.
I,
And
I
you're
honestly I honestly think it's a learning path in the journey of a syndicator.
yeah.
And that's something that you get to learn at the beginning when you're realizing, okay, this makes a lot more sense.
Yeah, yeah, and there's institutions will they look for operators that are vertically integrated, not just relying on third party, because you can truly compress the operational expenses when you're in alignment of interest through the
Mm,
construction phase, to the project management, property management, asset management. Everything's vertically aligned, and not one company is trying to make more profit off of another one because it's you distribute the expenses. So it's
Yeah, and we also had a conversation recently with the billionaire of multifamily, of course, right? And his story was a little bit unique because he actually started by acquiring a property management company that had over 5,000 units, and then he ended up acquiring another property management that had another, I think, 5,000. So all in, he was at 10,000 units. Well,
nice.
that gave him leverage to be able to go back and go to Wall Street and go to private equity firms and be like, hey, listen, this is what I have, and I see there's a big opportunity in the Sunbelt region. So that's why he was able to scale up, because he had the infrastructure to be able to take on all these, units and be able to manage it correctly. And now he's multi billionaire. But essentially, I think that foundation is very very critical. It could make you or break you, I would say.
Yeah, and usually they've got the first right of refusal to sell the property for the owner. So there's definitely a strategy there. I like that a lot. Um, Very cool. Can you elaborate on your approach to adding value to the properties? What do you look for? How much are you looking to spend? How much is it worth to spend in order to get the return? Are we looking at 2,000, 5,000, 10,000? How heavy of a lift?
Yeah, that's a great question. I know John can touch on it a little bit, but I would say typically in depends on the market, of course, right? If you're like in Charlotte, for instance, you might want to spend a little bit more money on the units. But in the markets that we're investing in, C class, B minus, we're typically investing between 5,000, I think 5 to 7,000 per unit, just to quick paint, flooring, maybe paint the kitchen cabinets. So that's typically what we're seeing, and essentially we want to be able to make that money back from the rents within the next 3 to 5 years. Essentially, that's kind of how we look at it. But it's funny because in Canada, we're actually spending between 30 to 35,000 per unit because
That's
it's a
insane.
yeah, which is a much there's a much higher end product that you have to perform. But then also the rent, for instance, we're getting from average $700 a building, we're getting between $1,600. So you're able to push the rents by so much. So it does end up working out. But yeah, in the States, I said between $5 to $7,000. John, what do you think?
Yeah, that is correct. And this current asset that we currently have, the capex plan is just to do flooring, cabinets. Thankfully enough, the all the properties come with steel appliances already, which is a great plus. And we're doing a face lift off of the outside of the building, so landscaping, paint, some pool furniture to bring the property back alive. And yeah, I mean the rents can be pushed already by quite a bit, so that's going to be able to draw a lot of young professionals that live nearby and be able to hit those performer rents. So yeah, no, really excited about it.
Is that the one that you all have under contract in Georgia?
Yeah, that's correct.
What kind of debt were you all able to get on that one?
Well, you know what? This one, and I said the last two projects that we've seen, and I think there's something, that we're seeing that's very common because of the interest rates. We're seeing that assumable loans seem to be really attractive right now in terms of like they're well as allowing us to really hit these numbers and cash flow and all these other things. So is assumable debt. This one has assumable debt, and yeah, a lot of I think the last two or three projects that we've looked at, they all have come with assumable debt, fixed rate for the next 10 years, five years of interest only. So really attractive terms. And that kind of allows us to mitigate the risk right now, which is interest rates. So I think that's, I'm not saying we're only going to buy these kind of assets currently, but these seem to be a really good asset class and debt to be able to acquire these assets. So yeah, it has an assumable loan on it. And I think it's at 4.5, 4.5 interest. But even the one that we were looking at before, we didn't end up purchasing this one, but we looked at another one and it had 3.5% interest only. 3.5% interest fixed for the next, like, I think 8 years or something, which was really, really phenomenal. But yeah, we're seeing that assumable loan is a really good way to mitigate the risk.
Yeah, I agree. Totally agree. If the assumable's a great strategy, as long as the sellers don't become totally unrealistic, where you've got to bring a lot of high cost equity to the table, and then even a supplemental, because you still have a blended interest rate
Mhm.
that you have to maintain. So it can be really good on a primary debt interest rate, and then by the time you blend it, it still doesn't make sense. So it's things to watch out for. There's a
Yeah,
lot of tripping hazards out there right now on just different things in the market. Still got sellers' expectations on how much they feel like they missed out on one of the highest the
yeah,
Yeah,
highest points in
yeah,
real estate. So it's kind of like a bittersweet moment because it's
yeah.
not coming back, in my opinion, anytime soon. Maybe
Yeah.
3 to 5 years, but
I
there's
think it'll start. I think it'll it'll ride the wave pretty high and maybe come down just a tiny bit, but not to what we used to be um, back
yeah,
in like 2018, 2019, for example. And on this asset that we have under contract, we were able to get a pretty good loan to value at about 70% because of the DCR of the property so good. So we're pretty
nice.
excited about the numbers on that one.
That's exciting. That's good.
yeah.
And
But what I wanted to say, or what I wanted to add to what we were talking about earlier. Oh, never mind. I lost my train of thought.
got it.
No
Um,
worries.
but yeah, I think that regardless, we've got a new value, a property value that's been created, so that will be met and then exceeded. As far as how high the market reached, it's just going to take a little bit of time. I think interest rates ultimately will come down, whether it's next year or the year, I think the year after. elections are next year, so yeah, anything can happen. It's going to be,
Yeah.
in my opinion, turbulent times just because of the environment. But just, if you can transact in this environment and in any environment, which everyone should try to, then I feel like you'll be safe through the years. Just got to make
No,
smart moves.
that's exactly. I've heard somebody say that. There's somebody said a big syndicate, I believe, said that. He said if you can make the deal make sense in this environment where insurance is high, where interest rates are high, rents are not really going up as high as they used to be, right? If you can transact and the deal makes sense in this environment, you're going to be gold when the interest rates come down, when the environment changes, when the rental keeps going up. So I feel like you should obviously buy in all markets as long as they're good deals and the deals make sense and you're mitigating the risk, kind of like what I mentioned earlier. But yeah, absolutely.
What kind of due diligence do you all perform once you have a property under contract?
Yeah, yeah. I mean, the due diligence is obviously there's a lot more other moving pieces that I would say due diligence, but a big portion of what we've seen is that the property management, our in-house property management, they do help out with a lot of the, checking out the leases, making sure everything is as planned, going through all the units. I mean, we still do it, but I find that our property management, our in-house property management, has helped us a lot with that procedure. But yeah, typically what we do is we just make sure that all the leases match what the seller had as advised us. We make sure there's no major capital expenditure that we haven't really looked at. We typically will go into every single one of the units. I know at some point it just becomes like repetitive. You're like walking through the same layout, but it's just part of the diligence. You want to make sure there's nothing hidden, nothing that you haven't been told. Yeah, other than that, anything, John, you want to add to due diligence?
No, I think like you said, the T12 um, paperwork is extremely important, and the inspection. I think that's where you're able to leverage a lot of the purchase price if you're able to have a good team member that can study the blueprints and the history of the building to make sure that, okay, what is up to date, what is missing, what wasn't disclosed properly. And on a lot of the assets that we've been involved in Canada before in the past, and even this one in Savannah, you're able to leverage a good amount of the purchase price just of the inspection. There's a lot of things that get missed, and that's where you're able to leverage a bit of the purchase price.
Yeah, yeah. When we're going in and our high level due diligence before the PSA is executed, we like to make sure that we check everything out that we possibly can, and then do, of course, your costs based on what ifs as well.
Hmm.
We still have we've not renegotiated on price. I don't foresee us needing to unless there's something majorly substantial and it's going to inhibit our ability to close the property. But if we go in with the PSA of we're going to buy it for X and then that's what we're going to buy it for, everyone's happy. There's a
Hmm.
balance. I mean, if something comes up, something comes up. You got to maintain that balance all the way through the closing. Like you had said, going through the units, it does come redundant, but you're also creating a brand new base for every unit in your property management software. So if you go in and digitally inspect the units, now you know if you move Susie Jane in there, you already know what the unit's going to be, and you get your reno team going in. So just creating a new base for your ownership to take over, and just diligence. I think it just helps what to expect moving forward.
Yeah, and I would say the only thing I would add is, you asked me earlier about passive investing, and this is also one of the benefits of being a passive investor is that you don't have to do due diligence. You just rely on the team, the asset management team and the GP team to be able to do the due diligence in your behalf and obviously give you any reports that you might find. So that's also another benefit of investing passively is that you don't have to do. There's a lot of work with the diligence, but if you can rely on a team, that has a track record that has been doing this, that you can synergize with, then essentially you can just rely on that and not have to do it yourself, right?
Yeah, totally. There's a ton of pitfalls in real estate. I mean, there's you can trip on your own shoestrings out there and just
And
land in a bad deal. It's just
Yeah.
absolutely. I mean, like for example, you can get so hyped about a deal at the beginning, and people don't understand how much you go through into a deal to actually be able to be like, hey, look, I have this amazing project. And they don't see all the work that was done before that. I mean, just on the diligence part, right? You got the environmental, you got phase one, you got phase two. So you're still hoping that those things check out, before you can even go out there and present your deal, make sure that there's no infrastructural damages or mold, or that the environmental comes back properly, or that the phase two and the appraisal come back great. So it's a long fight towards the end, but me and Jeff were looking, I think, at about close to 100 deals before we found
Yeah.
this one in Savannah. And it gets hard sometimes, right? You try not to give up because it's so many things that have to check out before you actually get a really good deal underhand. So yeah.
Yeah, no doubt. And there's, like you said, 100, 200 deals. You keep on just flipping through the turds out there, and
Yeah.
hopefully you find one good that actually pencils out. The seller's expectations aren't insane, and everything's balanced. It works out. And then then you still have to get everyone else to buy in and understand why it's such a good deal, and then close the thing. So there's a ton of moving parts. It's exciting. It's exhilarating, and can be depressing. And after it's done,
Stressed
then
out.
well, and after you close, then it's the real work truly begins. So it's not,
It's a long fight. It's a long fight.
yeah. So very cool. All right. So say one of the listeners wants to get a hold of you all, how can they reach out?
Yeah, so we're very active on social media. I think you may attach the social media links, but aside from that, they can visit Ortiz Equity Group, which is our last name Ortiz, equitygroup.com. And they can schedule a call with us. We do monthly webinars. We do have a podcast, very much like this one. It's called Passive Investing in U.S. Multifamily Show. And then we also do monthly meetups in Canada. So, we're pretty active: social media, Instagram, Facebook, TikTok. I mean, yeah, you'll be able to find us through Ortiz Equity Group. But yeah, that's we're very active on social media. We love more than anything sharing our journey.
Yeah.
Sharing share what real estate can do. Real estate is a very powerful tool if used in the right way. So, we're just very grateful. We don't really sell anything. We just kind of bring value. Hope that people can connect to our story, connect to kind of what we do, and basically attract investors instead of going out and trying to convince people to invest. Instead, attract investors and attract them to our story and what we've been able to do.
Yeah. In real estate, you have to tell people what you're doing. It takes one person to see what you're putting out. They call you and say, "Hey, I've got this deal." So if you're putting content out, you're pumping it out.
You know
It's
what? We've been seeing that in the last couple of weeks, and we're grateful for that for sure.
yeah. I mean, it's just it's give it and it receives, and you help people out along the journey, and more than anything, just prove to other people that it can be done, and you're proof, if at all, if just anything. So I definitely love it. Love your guys' journey. Look forward to following you all, and we'll certainly talk soon.
Thank you
Thank
so
you so
much.
much,
Thank you
Josh.
for